Good evening, everyone. Welcome to the quarterly webinar that we do for discretionary solutions. Uh, I will introduce Lakshmi Iyer. We will begin with an update from Lakshmi in terms of on the markets. Lakshmi is the CEO for investments and strategies for Kotak Alternate Asset Managers Limited. Over to you, Lakshmi.
Thanks, Nishant. Hi, very good afternoon to each one of you. Over the next few minutes, Nishant and team obviously are there to take you through the entire strategy, what really happened in the strategy, and the nuances and the way forward. But I thought I would take this time, just few minutes, to kind of give you a sneak peek into what really has happened in the last few months in the market. More importantly, the kind of volatility, the kind of massive sector rotation, and I would say the kind of drawdowns that we have seen, from the peak to where we are right now, while the broad markets may have just corrected maybe 10, 11, 12%, or 15%, depending on which index you are seeing. What effectively we are seeing from peak level stocks have corrected anywhere between lower end of 15-20% to upper end of even 45-50%. That has been the magnitude of volatility. Even the forget the stock and the sector rotation, I would say even globally, we have seen quite a few events, from Trump swearing in, if that were to be yes, one event which moves the market, to Bank of Japan hiking rates as recent as today. So I think all of these do have ramifications, in terms of the way you invest, in terms of which market cap to look at, in terms of which sector to look at. I think incrementally, I would say, and I'm happy, to share with all of you that the Agni Pariksha of all of this is something which the discretionary team has been able to weather through execution prowess, which has been displayed on Iconic. I don't want to steal the thunder from Nishan, but I think needless to say that doing over 8% alpha or excess outperformance since the inception, and managing not just the upside participation, but also risk adjusted return means drawdown, minimizing your downside risk. I think from end to end, and now it's been, good amount of time spent on this strategy, between the balance strategy, which is Optimus, and the current 100% equities. I think the team has actually completed a 5-year plus cycle to demonstrate the prowess of the strategy. So I think I would, probably summarize by saying that this strategy has actually displayed its mettle. It is here for the long haul. It is evidenced by the fact that we are gaining a lot of trust and confidence in terms of inflows from not only new investors but also from repeat investors over time. And my request is to all of you to continue to further this. It has executed our house views, our convictions pretty much to the T, whether it is passive, whether it is sector allocation, or whether it is market cap allocation. So I will pause here. Thank you once again for reposing faith in the abilities of the team and Kotak Alternates as a firm to deliver on what it had envisaged. And we believe there's more to come. Over to you, Nishant.
Thanks a lot, Lakshmi. To begin with, would take you through in terms of what the discretionary strategies stand for, what we endeavor to do here. Just a quick recap. The genesis of discretionary solutions has been that typically investors keep grappling with a lot of these decision making on the portfolio. Often they are colored by what's happening in the market. They have different behavioral emotions that can take over. The idea of discretionary solutions has been that in a lot more methodical, scientific manner, how we can provide disciplined solutions, which over a period of time, by staying true to the process and sticking to the discipline which they are meant to do, can achieve the investment objectives or a medium to long term. Over a period of time, we have launched different strategies. Ultimately, our objective remains that through discretionary solutions that we are creating, we want to help an investor optimize his time, cost, and return, at the same time offering them a smooth investment journey. At this point of a time, we run 3 AI strategies. Kotak Iconic, which is a 100% equity strategy. Kotak Optimus, which has 2 options. One is aggressive with 80% equity, 20 fixed income oriented, and the moderate strategy, which is 50% equity and 50% fixed income oriented. All of these three put together has scaled up to around 6,500 crores of assets. So many thanks to every investor for your trust and faith in us. Before we get into in terms of how the strategies have performed over the last quarter, a few dope in terms of the market. We know that the markets have turned a bit topsy-turvy, but how we are reading the market, I think this still very much holds true. Where for India, we have typically had periods where we've had good politics but bad economics, or bad economics and good politics. But to a large extent, what we are seeing is a combination of good politics and good economics aligned for a while now. India is well interestingly poised, even with a change of guard in US. What we are seeing is that India continues to play the two camps in the world pretty well, where everybody wants to be a friend of India. So we are balancing out geopolitics and our economic interests pretty well at this point of a time, which is very important when you want to attract offshore capital. India has been on a big capex spree, which is noticeable in terms of the spending by the government. Last 4 5 years has been characterized by the big push which the government has done in terms of the capex building with the economy. This financial year, we saw a bit of a lag in the first 6 months, which to an extent is also reflecting in the cyclical downturn which we are seeing in terms of the growth numbers. But we remain pretty confident that on this side, the government will keep pushing. Yes, the question mark remains in terms of the private capex, but we're confident that over the next few quarters, that should also show some signs of pickup. And where all has this capex happened? Will not go in much detail in terms of the defense roads. I think that is something which is well known, well read at this point of a time. Railways has been a big focus area also for this government. We'll spend a little more time on the ports and airports. Very interestingly, the government has focused on a multimodal logistics solutions for the country, where they have looked at roads, railways, ports, and airports as a combination. Uh, Ports play a very important role because even if you have a large manufacturing capacity in the country, you need ports and ships to export to different countries. There has been a big push from the government in terms of the port building, but also in terms of having your own fleet of ships. So India, over the next few years, will be building almost every ship for in a 4 days for the next decade, which is a substantial uh, shipbuilding spree which we are going to have. We are also looking to double the airport capacity in the country over the next 5 to 7 years, so which is a substantial kind of infrastructure building which the country is seeing at this point of a time. What we have seen in terms of the GDP or the investment to GDP ratio, that there has been a substantial uptick over the last 3 4 years. Typically, the Indian economy has gone through a lot of cycles, and these are slightly longer cycles over the last 20 years if you look at. But over the last 4 5 years, the investment to GDP ratio is showing a interesting uptick, and that trend is visible in terms of the activity that we are seeing all around us. More importantly, the formalization of the economy is reflecting and translating into corporate profitability. What this means is that even if, let's say, we are growing at a certain rate, which could be 9 to 12% in terms of uh, re nominal GDP, but the profitability for corporates has been slightly ahead because of the formalization which the economy is going through. Now, this is clearly reflected in terms of the net income of the BSE 500 companies as percentage of GDP, which for the last 4 5 years has shown a remarkable uptick. India Inc. continues to have a very, very strong balance sheet at this point of a time, which makes us confident that this bit of a cyclical downturn which we are seeing, they should be able to ride through, where the ROE for the companies remain very robust. And this is one cycle where they're not sitting on very high leverage in the balance sheets. So that is what should help them ride through this structural downturn much better and have the ability to bounce back also much faster. Typically, Indian equity market valuations have suffered whenever the inflation has been 8% or north. But for a while, the government has remained a very, very sharp focus on the inflation side, where we have been able to contain it in terms of manageable levels. So if you look at here, wherever inflation has been between a range of around 4 to 8%. Typical Indian market evaluations have remained pretty decent at around 16 to 18 times forward earnings. It is only those periods when inflation crosses that 8% number, that is when the equity markets take a beating. So from a structural perspective also, that is why we are seeing the government and the RBI maintain a vigilant stance on the inflation side. What has also been helpful and very healthy trend has been that the amount of spending which the government is doing there, a lot of the capex is happening in a lot of the spending is happening on the capex side rather than on the subsidy side. Though there has been some pressure on this both from the central government and state side in terms of the various doles which get rolled out in terms of the elections. But in spite of that, uh, the spending in terms of subsidy has seen a much smaller uptick as compared to the capex spending over the last 4 5 years. In the midst of this, what we are seeing right now in the earnings cycle, the numbers have been slightly disappointing. Disappointing in terms of the valuations which the market was trading at or the expectation which the market had built in. What we are perceiving this is that this is a healthy correction which was required, slightly long due in the market. But we may not bounce back immediately after this. This structural downturn typically lasts for a few quarters. We are around 3 to 4 months into a price correction in the index. We are seeing some amount of earning disappointment come through. And the nature of the market has been that they have been pretty unforgiving, where the reaction on most of the stocks have been around 5 to 10 or 50% correction if the numbers disappoint me. At this point of time, what we believe is the market valuations have corrected a bit. They're not very, very attractive. They're still not got into the zone where we would say that the earnings look very healthy or they're dipped below the long-term averages. But at the same time, our belief is the market may not correct that much where the earnings will fall below long-term averages. Investors, when they have to start dipping into the market, may have to look at a point where the valuations are giving us some comfort, though are not looking cheap as well. We will not be surprised if the markets maintain this sideways or volatile move for the next 3 to 4 months, which can't be ruled out. But yeah, we are not expecting any structural problems from economic perspective. It's more of a cyclical slowdown, which we are seeing right now. Moving on to in terms of an update on the funds, how they have performed over the last 3 months. A quick recap in terms of the philosophy that we follow for the solutions that we manage. Uh, in Iconic or Optimus, the investors get a complete portfolio solution for their investment objective, where the Kotak fund management team keeps looking at in terms of the markets, what should be the view on different asset class, or when do you increase the large cap or mid cap allocation in the strategies, which advisors to have, or which allocation to increase or reduce in the portfolio. That all is done by the Kotak fund management team. But when we choose an advisor in any of the underlying strategies, let's say some of the ones which we have in the portfolio could be Unify, Enam, Abacus, or ValueQuest. They are the ones earmarked for doing the stock picking or the sectoral allocation. But every investor in a simplified solution gets a complete portfolio solution auto-built across these two teams where the responsibilities are well split and clearly demarcated. What we're trying to solve for, two, three very important things. One is have a lot more disciplined scientific investment process. If you get that right logically over a period of time, the performance should follow. We are also trying to have solutions where investors find it a lot more investor friendly in terms of this fund structure and the operational convenience, which will be a lot more simpler for them to manage their investments on an operational side. At the same time, see how we can have a high element of interest in terms of the strategies which we pick up in the portfolio. Typically, most investors on the equity side will have a mix between large cap and mid cap, where large cap will be the dominant allocation. But what we have seen for a long period of time, that most active large cap managers have not been able to outperform Nifty 50 by a healthy margin, which would warrant paying that high fee to them. So that's why, as an approach, what we've adopted in our strategies has been that on the equity side of the portfolio, we use a combination of smart beta strategies to play the large cap allocation in the equity markets. And then we choose 3 to 5 active advisors on the portfolio to play the multi cap or the mid cap allocation, which we believe gives us a better approach and a control in terms of the equity allocation of an investor's portfolio. To narrow down in terms of which all passive strategies to play the large cap side of the market we would want to have, we use our in-house proprietary model where we keep analyzing almost 12 to 15 different passive indices on an ongoing basis, out of which in our strategies for an extended period of time, we have been playing a combination of the low volatility index and the momentum index. This we have intentionally used as a combination because both can exhibit very different behaviors in different sort of markets. For example, momentum in an uptrending market gives a lot more upside participation. But in a market like today, it can also be a lot more volatile, but low volatility would give you a lot more downside protection. So that's why we use both of them as a combination in different proportions. This one clearly highlights the benefit of this combination, where low volatility and momentum as a combination over a period of 3, 5, 10 years, and we can extend it even further, has outperformed Nifty 50 by a very healthy margin. In fact, this combination has been able to outperform most active large cap funds as well. So that's why to play the large cap allocation in our equity portfolios, we continue to use a combination of low volatility and momentum, but we may change their proportion and variations as per the market environment, which I'll take you through in terms of few changes which have happened in our portfolios. On top of it, from an extensive research of around 58 different advisors, we have chosen 5 different advisors to play across in our portfolios. A quick recap on the investment objective that we have maintained, and I'll take you through how we have been able to achieve this over a period of time. On the equity side of our portfolios, what we're keeping in mind is an objective of around Nifty plus 300 basis points. That's what the process is designed to possibly achieve over a medium to long-term perspective. At the same time, we will also endeavor to try and be in the quartile 1 of the median of various flexi cap funds over a medium to long term. However, the strategy in a volatile phase or a sideways phase, since we will remain largely fully invested and not take any cash calls, over a 3, 6 month, 8 month period when the markets are volatile or sideways, may dip briefly into quartile 3 or 4, where our endeavor will be not to go in quartile 4. So that is what we're trying to achieve as a process in terms of the strategies. A brief texture in terms of how the equity markets have played out. If I look at over the last 6 months between July to December 24, there were two halves in the market where July to September, the market delivered almost 8 to 8.5% absolute return. But in the month of October to December, the market almost gave away all of the entire set of returns. So the indices, Nifty 50 and Next 50 was slightly negative during the 6 month period between July to December. What is also noticeable is the percentage fall from the 52-week high for various indices. But more importantly, the nature of the market has been where the indices are not reflecting the true picture, where almost 45 to 60% of the stocks in various indices have corrected more than 20%. If I add the last 20, 22 days of Jan, possibly the fall will be much larger in terms of the number of stocks which have corrected. So what it means is that the broader market has corrected a lot more than possibly what is reflecting in terms of the pain in terms of the broader indices. And across the spectrum, it could be mid cap, small caps. The correction in the larger number of stocks has been much higher. This is how the iconic strategy has fared over the last quarter or 6 months. Starting with December, December was again a month where the market was slightly negative, where the index corrected around 2%. Iconic strategy was able to protect in this kind of a month as well. On a 6 month period when the markets have been slightly negative, the overall process and the setup in the fund has helped us where we have been able to protect in terms of the overall correction which the strategy has seen through. So we have now completed 6 completed quarters in the iconic strategy. Individually, in all 6 of these quarters, we have been able to outperform the benchmark, which shows a high element of consistency which the strategy is going through, where we have seen the market have a bullish tone and a bearish tone. In all those phases, so far the strategy has held up pretty well. Since the inception of the strategy, we are now clocking an 8.4% annualized alpha. Very interestingly, in this 19-month journey, since the strategy has been live, we have seen 5 months, 5 individual months which have been negative for the benchmark. Incidentally, in all 5 months so far, the strategy has been able to perform well. But typically, this is how what most funds will go through as a behavior. Most strategies which are oriented to outperform or capture the upside in an uptrending market much better. Typically, when the markets turn volatile, will also tend to fall a lot more. Very seldom, or by pure luck, will some funds be able to achieve a best of both on a consistent basis, where in an uptrending market, you're able to outperform by a very healthy margin. At the same time, when the markets fall, you're able to fall lesser. It's very difficult to completely rejig and achieve that as a combination. But typically, even by going through this cycle, most funds who stick to a process are able to deliver a 15, 16, 17% compounded return over a period of 5, 6 years. Logically, this is what every equity fund would go through. Now let's look at how the journey has been for Iconic Fund. There has been one phase of the market where the market was in a bullish tone, which was between June 23 to around 26 September 24. During this phase, the fund has been able to outperform the benchmark by a decent margin by having a volatility also which was in line or slightly lower than the benchmark. So what we always focus on in terms of the fund is not only in terms of the risk, the returns that the strategy is earmarked to generate, but also benchmark. But after 26 July, the markets have seen a bit of a corrective phase. During this corrective phase as well, the volatility in the fund was almost equivalent to that of the benchmark. So the volatility did not inch up materially, but the strategy was able to protect on the downside and fall lesser than the benchmark. Ideally, an aggressive strategy or any strategy which captures the upside much better, having a slightly higher beta may fall a little more, as we just saw in this chart. This is typically how a lot of funds will behave. But so far, the process has enabled us to, even on the correction of the market, to ride through in a much more better manner without any impact in terms of the overall volatility of the fund as well. So this is what Iconic Fund is endeavored to do. Typically, investors build up a portfolio across multiple funds, multiple PMSs or stocks spread across. What we believe in is, why should an investor spend so much time, effort, managing a so well spread out portfolio? A well thought through strategy like Iconic is designed like a complete equity portfolio solution where it can do the heavy lifting of having so many individual funds self-managed by an investor, and simple allocation like Iconic may be enough to have achieve the diversification and the investment objectives in the portfolio. That's the fund construct. So no change in terms of the overall strategies, where we continue to have the same advices, which is Unify, Enam, White Oak, ValueQuest, and Abacus on the active side of the portfolio. No change in terms of the strategies on the passive side as well. But we have had some rejig in terms of the mix, where the weightage to the active side of the portfolio over the last few quarters we had reduced, which has now helped us in this corrective phase of the market, where the passive side is much higher as compared to what we were probably 12, 15 months back. We also increased the allocation to a defensive strategy like low volatility, where it from the lowest allocated strategy when we started the fund, it became the highest allocated strategy, which has also helped us in terms of the downside protection on the portfolio. Moving on to the Optimus strategy. In Optimus, we have a combination of equity and fixed income. On the equity side, the process remains very similar to what we follow in terms of the Iconic fund. In fact, Iconic borrows that process from the Optimus strategies. But in Optimus, we also have a combination of equity and fixed income where we take overweight or underweight calls as per the market environment. We largely remain neutral in terms of the equity setup. So we have not reduced equity beyond the strategic allocation in any of the strategies, nor we have taken a disproportionate higher equity allocation. In fact, the methodology also outlines at what point of time the equity allocation gets increased or a profit booking by reducing equity in the portfolio gets triggered. In the months between June to August, the Optimus strategies between aggressive and the moderate, the model indicated a profit booking where the equity from a higher threshold of around 85, 86% in the aggressive strategy or 54, 55% in the moderate strategy, a profit booking was done and brought back to the strategic levels, which was 80% in the aggressive and 50% in the moderate strategy. With hindsight now, it looks like that the process indicated this profit booking trigger at the best possible time, where we just saw that from September onwards, the markets have been correcting. So the process outlined has worked well. We were able to safeguard and book those gains which were generated in the portfolios over the last 12-15 months. Since the last 4-5 months, the aggressive and moderate strategy both have had more conservative allocations on the equity side, which has again helped us in this volatile phase of the market. On the fixed income side of the Optimus portfolio, what we have done over the last 2-3 months, especially we have used the month of December to build up duration, where if you notice between September ending and December ending, across the portfolios, the duration has been built up. We look to make use of the opportunity available in this month as well to further add to that position. Possibly over the next couple of months is what we believe is again a good time in the various REITs or InvITs that we have in the portfolio, which has really helped us and contributed in terms of the overall returns on the fixed income and the overall portfolio. This is what the returns of the overall Optimus strategy, where all the 4 funds have been able to meet their investment objectives. Noticeable that for the Optimus funds, the returns showcased are net of tax, net of fees. In the Iconic fund, the returns shown are gross of tax and net of fees. So when we look at the Optimus funds as well, the overall investment objectives that strategies are designed to achieve, we have been able to meet those as well on a post-tax basis. I'll take a pause here and open it up for questions from investors. You can put your questions in the chat box. Okay, there has been a question in terms of the strategies on the Iconic side. So what we do there is that these strategies are adjusted based on the internal model that we run. So let's say when we want to be more risk on or risk off depending on the market environment, that is something which the team keeps analyzing. When we want to be more cautious on the market, like the current environment, the allocation to active strategies will get reduced and the allocation to passive strategies gets increased. At the same time, we also have the option of adding or replacing any of the advisors in the portfolio. So though we have 5 advisors in the portfolio, but if we believe that there is someone else that we want to add in the portfolio, that option is also available. So it provides a complete solution where anything which is required in terms of either the strategy, beta changes, or an addition or a replacement, that all seamlessly will keep happening on the portfolio. On the REIT side, what we have done in the portfolio is that we have looked to play the REIT allocation pretty constructively. This is a position we have been holding for around 18 to 20 months in the portfolio. We hold Embassy and Mindspace largely. We still believe that these remain interesting options where the numbers coming through in terms of the quarterly results have been pretty decent. We selectively keep analyzing different InvITs as well, where we have been very selective in terms of what we want to have. But for us, this has been an interesting way of playing the interest rate cycle as well, where instead of building only duration, we have looked at a combination of long duration bonds and REIT InvITs in the portfolio. I think there are no more questions. Would thank all of you for making your time and being here. We keep doing this on a every quarter basis to update you in terms of how the strategies are changing and shaping up. Would again see you in the next after the next quarter in the next quarterly update. Thanks a lot, investors, for joining in. Thank you very much.